I would say that for agents or brokers out there, we're not enemies. We're all working together in the real estate profession, and we're not here to kill deals. We're not here to cause trouble. We're here to provide an unbiased third party opinion of value. And we're here to protect the banks. And in essence, and if you broaden the scope, it's for the greater public good.
Welcome back to the Falls Homefront podcast, where we talk about real estate, business, and life right here in Wichita Falls and North Texas. I'm your host, Tim Lockhart. Today, I'm joined by Brady Enlow with Enlow Appraisals here in Wichita Falls. Brady plays a behind-the-scenes but critical role in almost every real estate transaction. And I'm excited to pull back the curtain on what appraisers really do, why it matters, and how it protects both buyers and sellers. Welcome to the show. I'm glad you're here.
Thank you for having me.
I always like to start with people's stories because no one wakes up one day as a kid and says, hey, I want to be an appraiser. How did you get into the appraisal business?
It's an interesting story. Not that interesting, but my dad is a real estate appraiser as well. And he started right out of college in the 80s. So he's been doing it for 43 years. And I always knew that I didn't want to be an appraiser. I didn't want to do what my dad wanted to do or what he was doing.
Right.
And I went to school at Midwestern State University here in town, and I studied education. And I wanted to be a teacher. And I taught school for 1 year. And I thought to myself, I cannot do this. I cannot be a teacher. And my dad talked to me graciously and said, hey, come work for me for a little bit and figure out where you want to land. And I loved it. I tried to avoid it, but I ended up joining the family business, and I have loved it ever since. So that was probably a little over 10 years ago that I started working with my dad and never looked back.
Oh, that's neat. Yeah, it's a tough job being a teacher, very important.
Yes, my wife is a teacher and she's got the calling, loves every bit of it. It's hard, but I didn't have that same passion. So I was like, I got to get out of here.
It's great that you found something that you are passionate about. What is that working in a family business?
There's a lot of different things that I hear about family businesses, but I'll say for me and my dad, I really love it. There's something that's priceless to be able to walk down the hall and talk to somebody with 40 plus years experience, or hey, how do you approach this complex issue, or how do you handle this type of valuation or this kind of property? And it's amazing to be able to have that wealth of knowledge. And on the flip side, I think maybe I brought some new ideas and perspectives to the office. Technology being a big factor of, hey, there's been a lot of things happening in the appraisal industry. And I think we've adopted some technology that maybe a lot of appraisal offices haven't, just because it's a big deal, or these guys have been doing it for 40 plus years or however long. And you're used to those things and it's hard to make a transition. So we complement each other. And I think for the absolute better for both of us. And I give all the credit to him. I learned everything from him, and I'm very appreciative to work alongside him. And I love it. So I hear different things about, oh, how could you work with your father? Oh, it's so difficult. But we love it. And my wife makes fun of me because I'll go home after a long day and I'll be recounting the day's story to her. And my dad will call me or I'll call him, and we're friends.
Yeah.
So it's great.
Oh, that's really great. Yeah. What surprised you most when you first started?
When I first started, the thing that surprised me, I guess, initially was I'd say, intense requirements at that time. They have lessened the requirements to get in the appraisal industry. It's not easy. And I had a leg up because my dad was in the industry, and finding somebody that will train you is difficult. Most people don't want to train their competition. And that was, I guess, something that surprised me. And at that time, again, it's lessened now. At that time when I started, you had to have a 4-year college degree, then 2 years minimum experience under another appraiser, and another hundreds of hours of classes on top of all of that. And so it was quite a bit. They've lessened those requirements in the previous years to try to encourage people to get in the industry. And I think that's helped some. I don't know how much because based on what the data says, I don't have an exact source, but most appraisers are older. The median age is significantly older.
Right. I heard, I can't remember what the source was either, but the average age of the appraisers across the nation is something like 65 years old or something like that.
Yes,
So
yes,
that's the
it's a very
average
old
age or
profession.
something like that. Yeah.
It's a
Right.
very old profession, and I think that rings true in our market area as well. In Wichita Falls, I think most of the appraisers are on a similar age, maybe a little younger, maybe a little older. There are a few younger people like myself in my 30s. I think there are a few, but not the majority.
And the hours of experience that you have to log to get the license is like a couple thousand
At that time,
hours.
yes, it was 2,000 hours of actual appraisal experience over a 2-year period, in which that doesn't include all of the hundreds of hours of classes that you had to take. Now I think it's for residential, it's 1,000 hours over a 1-year period.
That's still a full-time job.
Yeah, it is. It is. And it's difficult to get all of that up front. It's hard for people to make a living
Yeah.
in the early stages.
Right. Yeah. Yeah. Most buyers and sellers, I think, they hear the word appraisal. They don't really understand what's happening behind the scenes. Could you let us know?
Yeah, I definitely think that there's a mystery to appraisal of who is this? We've already had an inspection, we've already agreed to a price. Like, what's the big deal? And really, what it is, most transactions, say for a typical home financing purchase, we're working for the bank or the lender. They hire us to essentially complete collateral evaluation on the property. They want to make sure what is potentially going to be loaned out, the property will secure that. And that's essentially what it comes down to is collateral evaluation.
So you're basically working for the buyer's lender then.
Yes. So there also is a lot of confusion with that. And it's understandable. People maybe buy a house 2 or 3 times or however many times in their life, not often, and probably many years in between. But they are paying for the appraisal most of the time with their associated closing fees and other things, closing costs. And so even though they're paying for the appraisal, they're not our client. The lender that they're working with is our client. And so despite them paying for the appraisal, the lender is our client. So we're working for the lender evaluating the collateral.
Yeah, in 2010, there was the Dodd-Frank Act that followed the big real estate turmoil that happened in 2008 and everything. And I guess the intent behind that was to separate the distance between the lenders, the real estate agents, and the appraisers to make sure the banks were getting like true third party valuations. And so during that time, they created the appraisal management companies, or AMCs that they're called. How do you interact with the AMCs? How does that change how you're doing or affect how you're doing business?
Yeah, so I'll be clear out on the outset. I do work for appraisal management companies, or AMCs as they're colloquial called, and they have a mixed reputation. There are a lot of good ones out there, and there are a lot of bad ones, unfortunately. And I guess to your point, post 2008, post crisis, they were trying to find ways to keep everybody at arm's length, the lenders, the appraisers, the borrowers, and prevent collusion, truly have an unbiased opinion. Now, that was before my time, but hearing stories from my dad, it wasn't uncommon for certain banks to call the appraiser and say, now, we need this number on this. We got to make this work. And obviously, not okay. And there was a lot of pressure. And so, most of the time, it's not a big deal. We're going to do our job regardless. It doesn't matter. But you could see the potential hurdles or issues with that where, hey, this particular client orders 50% of my work in a year, and they're telling me I've got to make this deal work. And then you could see, oh gosh, if I don't, then they're going to potentially turn off the work or not send me anything else. But with appraisal management companies, there's a perceived arm's length nature to where the loan officer is not calling the appraiser, pressuring them. But with that comes a whole host of other issues. I can get into those if you want me to.
Oh, just a high level. One thing that I see from my perspective is that now there's just
Mhm.
so many appraisal management companies.
Oh gosh.
All of them require you to go through all these hoops to get approved through them, but they may only give you a handful of appraisals a year. And so then that creates a lot of extra workload, I think, on your end, does it not?
Yes. So I'd say hundreds. There's probably hundreds out there nationally. And how many I'm on the panel, I don't know, maybe 20, maybe 30. I'm not sure. And I don't do a lot of work for them. So the other aspect is, yes, I'm not having that any kind of pressure, but at the same time, they have to make a living. And so this is where a lot of appraisers have a little heartburn, if you will, how this works, because say the loan company tells the buyer, yeah, okay, we're going to charge $1,000 for the appraisal or 800 bucks or whatever it is. Maybe the appraisal management company only sends a bid to an appraiser here locally and say, hey, we need this property appraised and we'll give you 350 bucks. And you're like, whoa, gosh, that's way below standard of what our other clients. So they can be motivated to try to find the cheapest, and the cheapest doesn't always mean the best, and that increases their profit margin. So some of them can have a bad reputation where they're only hunting for the cheapest, or they'll continue bidding this out, trying to find somebody cheaper. And then on your side, hey, well, we can't find an appraiser. We can't find an appraiser. And then your transaction's delayed and your buyers can't buy and your sellers can't sell. But the truth of the matter may be that they just can't find an appraiser that's cheap enough. And there's a lot of nuance to that conversation.
Mm-hmm. Yeah. Yeah. Just for the people out there to know, there's a lot of moving parts even before you get
Mhm.
the order to do that.
Oh, yes.
Yeah, but the third party opinion of value is very important for making sure we have a healthy real estate market.
Yes.
And so that's very important. Yeah. What happens from your end if the contract price is higher than the value that you find?
Okay, that happens occasionally, and for a multitude of reasons. It may not necessarily reflect poorly on the listing agent who's done the market analysis and said, "Hey, I think your house is worth this," and you have people that say, "Yeah, I think it's worth this," and they enter into a contract. It could be that maybe the house is smaller. I've had that happen frequently, a number of times in the past few weeks, where the house was supposed to be a much larger size. And whenever I go out and measure the property, it turns out it's a lot smaller. And so when you do your final analysis, you lose a lot of square footage in the home, you lose a lot of value, contributory value. Oh, huge. And so what I would say, if the appraisal comes in below a contract, I would say to anybody involved, please review the appraisal. Look at the data. Look at the comps that are being used. Look at the adjustments. Try to determine what's going on and see if there's anything that the appraiser missed. It's possible we're not perfect. Or look at other comp data. Hey, he's used 4 sales. What else did he omit? What did he overlook? Or if possible, but I'd say be data driven. It's so easy to throw shade at appraisers if something doesn't come in at the contract price. But I'd say be data driven and say, hey, did you consider this? And then there's a process now, there always has been, but I don't think it was as common, called the reconsideration of value or ROV request. So if you or your client think, hey, the appraiser's missed something, or did you consider this? You can officially request an ROV through your lender, and they will send it to the appraiser, and they are required to address that. And they will look through the data that's presented and see if there's any change warranted.
Okay, that's good. That helps to know that. So that's good
Yes,
for the
yes.
buyers
And
out
I
there
really
to know that.
encourage that. I encourage that frequently because every now and then something happens. There's something weird. It's a hard, unique property. Everybody thinks, oh, it's so simple. Zillow says this, the county says this. But you and I both know that properties are very unique in nature on some occasion, and it's hard to value. It's hard to find comps. And so we're only as good as the data.
Yeah, let's flip to the other side because from the seller's perspective, emotions can run high. They're planning their move and everything. From your perspective, what should a home seller expect when the appraisal is ordered?
I'd say the first thing is be aware that we're going to come because a lot of the times you get a property in contract, you've already had the inspection, you got past the option period. They're like, oh, who are you? Or they'll deny our request to look at a property through our listing service. But from their perspective, just know that we are going to come into the property. We're going to measure the exterior for residential. We're going to measure the exterior. We're going to look at all the rooms. We're going to take photos. And depending on what kind of loan and appraisal it is, if it's FHA, VA, we're going to do a couple of little minor tests. We're going to look in the attic. We're going to look in the crawl space if they exist. We're going to run some water, test the electrical systems and plumbing systems. It's so high, 30,000 feet level. It's not an inspection. And we're looking for deferred maintenance or things that would prohibit the property from meeting minimum property requirements. Just know that an appraiser is looking for those things. Probably the number one issue that I come across is peeling paint on pre 1978 homes, even after 1978, but VA, FHA, USDA, you can't have peeling paint. And so those are required repairs. And then we're not looking at your personal property. I'm not looking at your furniture or any photos. I'm only looking at the bones of the property.
Yeah, so that's a good point that you brought up about the different types of loans. A lot of people think that as a seller, getting an offer that a conventional loan might be better than FHA or a VA loan, which that's not always the case. I think the main difference is the appraisal requirements.
Mhm.
And there's not like a specific checklist that you go through, but in addition to peeling paint, there can't be any broken windows and all the systems have to work. But what else is different between the VA, the FHA, and the conventional appraisal process?
Okay, yeah. So the first thing that I would say is conventional is typically perceived as the least restrictive. Properties still have to have meet certain requirements for Fannie Mae and Freddie Mac and other conventional secondary market end users, if you will. But conventional doesn't mean anything can go. That's a normal thing that I hear from a lot of agents. Oh, just let it go conventional. And unless it's an in-house portfolio loan for a local bank or something, it's got to still meet requirements. So you can't have settlement, you can't have the roof blown off or broken windows, real major issues. You can't have that. FHA and VA are a little more stringent. You can't have the peeling paint. You can't have a lot of hazards or electrical issues. And with FHA, you have to have the utilities on. We got to be able to test the water. So it's not uncommon if somebody moves out, oh, they're going to turn the water off or turn the electricity off, but they'll have to be on for FHA. VA, you don't have to do that. I don't know if that's a commonly known thing here, but the VA, you don't have to have the utilities on. But it's like this weird thing where the utilities and all the systems are required to work, but the appraiser's not required to test them. They take that out of the appraiser's scope of work, where FHA still wants us to test a few things. But typically, FHA and VA are viewed as slightly more stringent. And I also want to say that the VA, for some reason, I've heard and hear that people perceive them as more challenging or more difficult, or the loans are not as good as compared to conventional or VA, or excuse me, FHA. And from our perspective, that's not true. It's a good program, and if anything, VA has a good service for the veterans, where the appraisal fee is flat, no matter what. There might be a few extenuating circumstances if they can't get an appraiser in the local county, where they might pay a little extra, but all VA appraisals are going to have the same fee in your respective region. So that gives buyers peace of mind. If you're trying to do something, they're going to find an appraiser, and you're not going to get perhaps overcharged by an AMC or an appraiser who's going to make a bunch of money on this. It's a flat fee, which is it's a good thing for the veteran.
Yes, it is. Yeah. And also from my perspective, the VA loans tend to go typically actually smoother than the other types
Mhm.
of loans, smoother than conventional. And at least recently, I've noticed that there's been shorter timelines between the time that the appraisal is ordered and delivered for the VA versus the other types of loans, specifically conventional tends to, for some reason, takes longer to get the appraisals in.
It's highly dependent. Back to your point of AMCs, if they order the appraisal through an AMC, it can add some layers of complication and make things take longer. If it's a local bank that we have a direct relationship with, we usually are able to get them done a little bit faster. The VA, again, is very strict. If you're on the VA appraiser panel, you have to adhere to their rules. And one of those being, at least here in Texas, you have 10 business days from receipt of the appraisal request to get it done. And there's no, that's it. If you're going to be on the VA panel,
Yeah.
you have to adhere. Otherwise, they'll kick you off.
Yeah. Yeah, that's good. That's probably why some come back quicker.
Yes.
So that's good. Yeah. How about the comparable sales and like the time frame? How close to the current date and how far do you go in finding comparables?
Sure, I can speak to that. So when we're doing a typical single family appraisal, there's a lot of old school misnomer information of, oh, it only has to be, you can't go over a couple of months, or it has to be within a mile radius. And I think those things in spirit, like I understand where they're coming from. But when I'm looking for comparables, I'm going to look specifically in the neighborhood where the subject property resides. And that may be more than a mile. It depends on the geography of the neighborhood. But I'm going to search the neighborhood, and then you start looking at things like age, size, condition, quality, other amenities. Does it have a pool? Does it have a shop, or whatever it may have? And I'm going to try to find things similar to the subject. And ideally, appraisal practice theory, if you find something a little bit better, okay, I know this is better than the subject, and you find something a little bit worse, like I know this is inferior, then that kind of helps you determine, okay, I'm not this, I'm not this, I must be somewhere in the middle, or to some element. It's a rudimentary theory, but that kind of helps you narrow it down. And then as far as timing, the more current, the better, because that's more reflective of the current market conditions that we're experiencing. You can go back further in time. Most banks and lenders, they like 3 months or less. But in Wichita Falls, that can be a little more challenging depending on what neighborhood you're at. Maybe there's only two or three sales in the past year in a certain neighborhood. If it's built up and nobody's moved, you don't have comps. So you got to go back further in time. Or in certain circumstances, you go to competing neighborhoods. Here in Wichita Falls, a lot of homes were built in the 70s. And maybe I'm in a certain 70s neighborhood and there's only one or two sales that are truly comparable to the subject. I may need to like poke around and see what other sales are in competing 70s neighborhoods if there's nothing in the neighborhood. You can go up to a year, is typically what we see in Wichita Falls. In extreme circumstances, I'll dip over a year to 2 years, if something's really unique and there's no sales, or I'm thinking something on large acreage, large square foot, something very unique about the property where I'm hunting for a comp and I'm just not finding anything in the most recent 12 months. I might dip over a year. And then if you do those kinds of things, the appraiser, a good appraiser, is still going to account for the differences. I'm going to measure the market appreciation, or if there is any, and say, hey, this other sale over a year, 18 months ago, and the market's gone up median couple points or something, then I'll adjust that old comp to bring it to a current level of the current market. So you can make time adjustments if necessary.
All right, that's interesting. Do you have any memorable appraisal stories, something unusual or funny?
I have quite a few, but the one that comes to mind, I was at a property and we're measuring, and I get to the backyard, and there's not what you would think, like a dog or something like that. Honest to goodness, there is a hog. And we're not talking like a domesticated pig or it was a wild boar that these people, I was like, oh my gosh, what am I supposed to do? They had trapped it or something like that when it was little, and they kept it as a pet.
Oh
So it had
my.
grown, and it was this wild boar in the backyard, and it had tusks. It was quite the unique experience. And in order to pacify the hog so I could measure the back of the house, I remember the owner was feeding it pizza.
Oh my goodness. Pizza.
Yes, yes. It was one of the most bizarre moments, but we got it figured out.
That is pretty bizarre. Yeah. Do you have any advice that you could give to home buyers or sellers?
Yeah, I would say a lot of people ask me what kind of improvements, what increases the value of your home? And I would say rely on local market knowledge. You can read online, Zillow says this, your paint color will increase your house by $800 or whatever. There's a lot of people that want to tell you, you can increase the value of your home by X or by doing this. And I'd say scrutinize that. Think about it. Of course, the solar panel company that's knocking on your door is going to tell you that if you put on solar panels, it's going to increase the value of your home. I would say, please do your research and knowledge, talk to professionals. In our market area, that's not the case. It can increase the value of your home, but typically not dollar for dollar. And a lot of people, unfortunately, get in bad financial situations because they borrow a lot of money to put these panels on, and they don't contribute that much money value here in the resale. Same thing with pools. Pools, the cost of those have gone up dramatically over a few years. Most of the time, again, in our market area, they're not dollar for dollar. They'll put in $100,000 pool, and sometimes in a certain market segment, it might be worth 50. And that's hard. That's very difficult for people to recuperate from. I'd say most of the time, the biggest impacts on value, again, here locally, it's very nuanced. It's different everywhere, but here you see the biggest return on kitchens, bathrooms, flooring, and honestly, paint. I think paint makes a big difference in buyer perception. So those are the biggest things that I think increase the value of a home here locally, whereas perhaps solar panels and other improvements, maybe not as much.
Thanks. That's some great advice. Is there anything else that we didn't cover that you think people should know?
Well, I would say that for agents or brokers out there, we're not enemies. We're all working together in the real estate profession, and we're not here to kill deals. We're not here to cause trouble. We're here to provide an unbiased third party opinion of value. And we're here to protect the banks. And in essence, and if you broaden the scope, it's for the greater public good. If every bank, every lender out there is doing stuff that they shouldn't be doing, and there's no roadblocks, there's no somebody looking into this, you could see yourself into quite a catastrophe. And so we're here to promote public trust and public good. And so we're not enemies, we're not villains, we're just doing our job.
Yes. No, that's great. Yeah. Thanks, Brady, for taking the time to share your perspective with us. The appraisals are one of those parts of real estate transaction that matter enormously, yet most people don't fully understand. So I think this was very valuable for our listeners.
Yeah, thank you.
Yes. And to everyone listening out there, thanks for tuning in to the Falls Homefront podcast. If you found this helpful, be sure to subscribe, to share it with someone who's buying or selling a home in the area, and we'll see you on the next episode. Appreciate you tuning in. Want more insider tips on buying, selling, and investing in Wichita Falls and North Texas? Subscribe now and keep watching. Your next move starts here.